Diversified Royalty operates under a business model that prioritizes the acquisition of trademarks and intellectual property from established, well-managed businesses. In exchange for these assets, the corporation licenses them back to the original operators in perpetuity, receiving a royalty typically based on gross sales or a fixed periodically adjusted amount. This structure is fundamentally different from a traditional holding company or private equity firm because it removes the corporation from the direct impact of operating expenses, such as labor costs, rent increases, and commodity price fluctuations. The model has relative insulation from margin compression. In a standard retail or service business, a 10% increase in gross revenue might be entirely offset by a 12% increase in labor and input costs, leading to a decline in net profit. However, for a top-line royalty holder like Diversified Royalty, the royalty payment remains tied to the revenue rather than the shrinking profit margin. This mechanism serves as a natural hedge against inflation, provided the royalty partners can maintain their sales volume. The bear case: structural risks and sustainability hurdles. The bear case focuses on the thin margin for error regarding dividend sustainability, the lingering issues within the real estate portfolio, and the rising debt burden in a high-rate environment. Dividend sustainability and the payout ratio conflict. A central point of concern for bear case analysts is the sustainability of the monthly dividend. Critics point to a historical payout ratio that has, at times, exceeded 100% of earnings. According to some estimates, the company has paid out up to 145% of its GAAP earnings as dividends. While management focuses on distributable cash rather than net income, accounting for non-cash items like trademark amortization and impairment, the gap remains high enough to warrant caution. If the corporation fails to generate sufficient free cash flow to cover the dividend, it may be forced to rely on its dividend reinvestment plan to preserve cash or issue new shares, which would be dilutive to existing shareholders. As of late 2025, the payout ratio on a distributable cash basis was approximately 88% for the first half of the year. However, with recent dividend increases taking the annualized payout to 0.285, the requirement for organic growth from partners to keep the ratio below 90% is significant. Real estate headwinds. The Sutton Group Relief Agreement. The performance of the Sutton Group remains the most significant drag on the portfolio. The residential real estate market in Canada has faced challenges due to high interest rates, leading to a reduction in transaction volumes and agent counts. In late 2025, Diversified Royalty was forced to enter into a substantial royalty relief agreement with Sutton. The details of this agreement highlight the severity of the situation. Forgiveness. 20% of deferred royalties from October 2024 to September 2025 were entirely forgiven. Waiver. 33% of the royalties payable from October 2025 to December 2026 are waived to support Sutton's business development and recruitment initiatives. Impairment risk. These waivers may lead to further non-cash write-downs of the Sutton intangible assets at the end of 2025. The bear case argues that the need for such extensive relief suggests that the Sutton business model, based on a monthly fee of $68.56 per agent, is under structural pressure as agents move toward higher commission split models or leave the industry during housing market lulls. Rising debt and interest coverage. To fund its growth, Diversified Royalty has taken on significant debt. As of September 30, 2025, bank loans totaled $206 million, a substantial increase from $176 million at the end of 2024. The February 2026 issuance of $60 million in 5.75% convertible debentures, while providing liquidity for acquisitions, adds to the total interest expense. In a macroeconomic environment where the Bank of Canada is expected to hold interest rates steady at around 2.25% through 2026, the corporation's debt servicing costs will remain elevated compared to the ultra-low rate environment of the previous decade. The bull case: drivers of accretive growth and stability. The bullish thesis for Diversified Royalty Corp. In 2026 is anchored by the successful de-risking of its legacy assets and the aggressive expansion of its newer, high-growth partnerships. The transition of the Air Miles royalty from a volatile, declining asset into a high credit quality fixed income stream is perhaps the most significant catalyst for the stock's recent re-rating.
Historically, the Air Miles royalty was a source of persistent concern for the corporation, as the program faced headwinds from the loss of major sponsors and a general decline in consumer engagement. However, the January 2026 amendment to the license agreements with Bank of Montreal has fundamentally altered the risk profile of this asset. BMO, which acquired the Air Miles Reward Program business out of the Loyalty One CCAA proceedings in 2023, has now entered into a 10-year agreement to pay Diversified Royalty a fixed annual royalty of approximately $3.925 million. This payment is not only guaranteed by BMO, a Tier 1 Canadian bank, but it also represents a 20% increase over the $3.2 million generated in 2025. Furthermore, the agreement includes a contractual growth rate of 2.42% per annum beginning in February 2027. This transition turns the corporation's weakest performing royalty into one of its strongest on a risk-adjusted basis, providing a bond-like floor to the cash flow statement. The launch of BMO's Blue Rewards program in summer 2026, which replaces the legacy Air Miles structure with enhanced flexibility and point-earning potential, is expected to revitalize the brand's consumer appeal, further securing the long-term viability of the trademark.
Mr. Lube Plus Tires. Mr. Lube Plus Tires remains the cornerstone of the portfolio, accounting for roughly 45% of total revenue. Its performance in recent years has been exemplary, with same-store sales growth reaching 10.5% for the full year 2024 and maintaining strong momentum into 2025. This growth is driven by two primary factors: the aging Canadian vehicle fleet and the strategic expansion into the tire service market. The complexity of modern vehicles has made do-it-yourself maintenance nearly impossible for the average consumer, driving higher volumes to standardized service providers like Mr. Lube. Additionally, the tire segment provides a significant uplift in average ticket size. In May 2025, the royalty pool was adjusted to include 6 new flagship locations, and as of early 2026, the partnership continues to benefit from the implementation of best practices across its nationwide network. The top-line royalty for Mr. Lube is structured as 7.95% per non-tire sales and 2.50% of tire sales, ensuring that Diversified Royalty captures the benefits of both high-margin oil services and high-revenue tire sales. Expansion in the quick-service restaurant QSR segment. The bull case also relies on the rapid expansion of Bar Burrito and Cheba Hut. Bar Burrito, Canada's largest quick-service Mexican chain, currently pays a fixed royalty of $8.6 million per annum, which grows at 4% annually through 2030. This provides immediate visibility into cash flow growth, regardless of broader economic fluctuations. In 2031, the royalty will transition to a variable model based on gross sales, allowing Diversified Royalty to participate in the long-term upside of the brand's maturity. Company Deep Dive. Mr. Lube's success is not just a function of market position, but of operational optimization. The partnership achieved an 11.8% increase in royalty income in Q1 2024, supported by a 6% organic royalty growth rate. The brand's focus on top-tier franchisees has limited the churn within the network. For 2026, the integration of new flagship locations into the royalty pool is expected to offset any broader slowdown in consumer discretionary spending, as oil changes and tire maintenance are viewed as non-discretionary for vehicle longevity. Mr. Mike's, Western Canadian Dynamics. Mr. Mike's, which primarily operates casual steakhouse restaurants in Western Canada, has seen more volatile results. In the fourth quarter of 2024, the brand reported negative SSSG, reflecting the sensitivity of the casual dining segment to inflationary pressures on Canadian households. However, by early 2026, the brand had reached a milestone of 50 locations and announced plans to expand into Ontario and Atlantic Canada. This diversification outside of its traditional Western base is a key component of the bull case for the partnership's stability. Nurse Next Door. Demographic resilience. Nurse Next Door remains a high-floor, low-ceiling partner. The royalty entitlement grows at a fixed rate of 2% per annum, with the most recent increase effected October 2024. As a leading home care provider in North America and Australia, the brand is perfectly positioned to benefit from the aging population, which is a structural rather than cyclical trend. For Diversified Royalty, this represents the most defensive component of the portfolio, though it offers less upside during economic booms than the percentage of sales models. Stratus Building Solutions, the U.S. service anchor.
Stratus Building Solutions provides a fixed royalty of $6.7 million per annum, which increased by 5% in November 2025 and is scheduled for another 5% increase in November 2026. As a provider of commercial cleaning services, Stratus operates in a sector with high recurring revenue and long-term contracts. For 2026, the US dollar exposure provides a natural hedge for the corporation against a potentially weaker Canadian dollar. 2026 dividend. Diversified Royalty has established a consistent record of monthly dividend payments, which is a primary draw for its investor base. The corporation's dividends are designated as eligible dividends, providing a tax-efficient mechanism for Canadian investors in taxable accounts. The compound annual growth rate for the dividend since 2016 is approximately 4.2%, moving from an annual total of $0.188 to $0.285. This growth has been achieved despite the 2020-2022 economic turbulence, suggesting a disciplined approach to capital distribution. Financial strategy: the February 2026 debenture offering. In February 2026, Diversified Royalty successfully closed a bought deal public offering of 5.75% convertible unsecured subordinate debentures. This transaction is critical to understanding the corporation's midterm financial strategy.
Principal amount: $60 million. Over allotment: underwriters exercised an option for an additional $9 million, bringing the total gross proceeds to $69 million. Terms: 5.75% annual interest payable semi-annually, maturing March 31, 2031. Conversion price: $5.35 per common share. Use of proceeds: repayment of outstanding amounts under the corporation's acquisition facility and funding of expected additions to royalty pools. The conversion price of $5.35 represents a significant premium to the trading price in early 2026, indicating that management and the underwriting syndicate believe there is substantial upside potential for the common shares. By paying down the acquisition facility, the corporation frees up its credit lines to pursue the next accretive royalty acquisition, which is essential to keeping the payout ratio in check. Sector and peer comparison. To accurately value Diversified Royalty, it must be viewed against its primary competitors in the Canadian royalty and income space, Alaris Equity Partners and A&W Revenue Royalties Income Fund. Alaris Equity Partners offers a higher yield and a lower payout ratio, but its business model, providing alternative financing to private companies in exchange for preferred distributions, carries a different risk profile than Diversified Royalty's top-line royalty structure. A&W is a more stable, single-asset brand, but provides less diversification. Diversified Royalty remains the choice for investors who want a blend of high-growth QSR, Chiba Hut, Barburrito, and solid service anchors, Mr. Lube, BMO Air Miles. Key takeaways: bull case versus bear case synthesis. Bull case reiteration. The BMO guarantee. The Air Miles royalty is no longer a declining risk, but a guaranteed growth asset backed by BMO. Organic growth engine. Mr. Lube continues to deliver double-digit growth in its core segments, anchoring the portfolio's cash flow. U.S. expansion. Cheba Hut provides a scalable growth platform in the massive U.S. QSR market. Capital discipline. The $69 million debenture raise at 5.75% allows for future accretive acquisitions while fixing long-term interest costs. Bear case reiteration. Thin safety margin. The payout ratio remains uncomfortably high, leaving the dividend vulnerable to any significant partner failure. Sutton structural decay. The ongoing need for royalty relief at Sutton Group suggests a business model that may be losing relevance in the modern real estate era. Debt sensitivity. Elevated bank loans and convertible debentures increase the corporation's sensitivity to a prolonged high-interest rate environment. Consumer softness. A mid-2026 recession could hit casual dining, Mr. Mike's, and supplemental education, Oxford Learning, harder than anticipated. Conclusion. Diversified Royalty enters 2026 as a more robust and better diversified entity than it was at the start of the decade. The management's proactive approach in renegotiating the Air Miles agreement and pivoting toward U.S.-based QSR brands has successfully mitigated many of the legacy risks that historically weighed on the stock's multiple. While the Sutton Group situation and the high payout ratio remain legitimate points of concern, the corporation's track record of stability and the high credit quality of its new anchors suggest that the current 7% yield is sustainable for the foreseeable future. For the income-focused investor, Diversified Royalty offers a combination of defensive service-based cash flows and aggressive franchise-led growth potential. Provided the corporation continues to execute on its accretive acquisition strategy and can avoid further impairments in its real estate segment, it is well positioned to meet its price targets and continue its decade-long tradition of monthly distributions.